They said it was different, not just another crypto experiment, not just another risky bet. This was supposed to be stable, a digital dollar, powered by code, protected by math, not trust. For a moment, it felt like the future of finance had arrived. No banks, no middlemen, no governments standing in the way. Just algorithms, incentives, and absolute confidence. Investors were promised something extraordinary: 20% annual yield on what was described as a stable digital asset. Billions of dollars poured in, retail investors, crypto funds, even institutions. But beneath the surface, the system wasn't built to withstand stress. And when confidence finally cracked, the system didn't bend. It collapsed. This is the story of Terra USD, Luna, and the $60 billion illusion that vanished in a matter of days. In 2018, Terraform Labs emerged with a bold ambition. Founded by Du Quan and Daniel Shin, the company set out to build a decentralized payments ecosystem, one that could operate globally without relying on banks, governments, or intermediaries. At the center of that vision was Terra, a blockchain designed to support stablecoins, starting with Terra USD, or UST. Unlike traditional stablecoins backed by real dollars, UST relied entirely on an algorithm. Its stability was maintained through a dual token system, UST and Luna. The idea was simple. If UST traded above $1, new tokens could be minted. If it fell below $1, it could be burned, exchanged for Luna. In theory, market incentives would restore balance. No reserves, no collateral, no central bank standing behind the system. Just code, just incentives, and trust. On paper, it was elegant. But elegance in theory does not guarantee resilience in reality, because this system depended on one thing above all else: confidence. Then came Anchor Protocol. Anchor was designed to be the backbone of the Terra ecosystem, a place where users could park their UST and earn what was advertised as stable, predictable yield. The promise was extraordinary: up to 20% annual returns on a digital asset that was supposed to behave like cash. In a world of near-zero interest rates, this wasn't just attractive. It felt revolutionary. Money poured in, retail investors chasing passive income, crypto funds looking for low-risk yield, and institutions searching for alternatives to traditional finance. By early 2022, Anchor was holding more than $14 billion worth of UST. It quickly earned a nickname: the Crypto Savings Account. But the yield wasn't generated the way many assumed. It wasn't the result of organic lending demand. It wasn't powered by sustainable cash flow. It was subsidized. Terraform Labs and early backers quietly injected capital to maintain the promised yield. Behind the scenes, Anchor's yield reserve was constantly draining, and each refill bought time. But it also deepened the system's dependence on uninterrupted confidence. The higher the yield, the more capital flowed in. And the more capital flowed in, the more catastrophic a sudden exit would become. Anchor wasn't just attracting users, it was concentrating risk. As the broader crypto market began to cool, pressure inside the Terra ecosystem started to build. At first, the warning signs were subtle, easy to ignore. Anchor's yield reserve was draining faster than expected. Behind the scenes, developers quietly stepped in to refill it. To most users, nothing seemed wrong. The interface still showed 20%. Withdrawals still worked. But analysts were growing uneasy. How long could the subsidies last? And what would happen when they stopped? Because Terra USD wasn't backed by dollars. It wasn't backed by treasuries, it was backed by belief. And belief is fragile. If enough investors decided to exit at the same time, UST would be redeemed for Luna. That redemption would mint new Luna tokens, increasing supply, pressuring price. It was a feedback loop, one that worked perfectly in calm conditions and catastrophically under stress. Still, most investors believed the system would hold. After all, it always had before. Early May 2022. What had been theoretical risk suddenly became reality. A large withdrawal from a liquidity pool pushed Terra USD below its peg. $1, then 99 cents. At first, the deviation looked manageable. But markets don't move on logic alone. They move on psychology, and psychology shifted fast. As confidence began to fracture, investors rushed to exit. UST was redeemed for Luna at massive scale. To defend the peg, the protocol did exactly what it was designed to do. It minted new Luna tokens. But each new token increased supply, and each increase pushed the price lower. The mechanism meant to restore stability was now accelerating collapse. This was no longer a temporary imbalance. It was a self-reinforcing spiral, the death spiral. In less than a week, the Terra ecosystem collapsed. Luna fell from over $100 to fractions of a cent. More than $60 billion in market value vanished. For many investors, there was no time to react. Savings were wiped out. Life-changing money disappeared. Across the crypto industry, shock quickly turned into panic. Funds froze withdrawals. Lenders faced liquidity crises. Confidence evaporated. The collapse didn't stay contained, it spread. Bitcoin reserves meant to defend the system were sold in a last desperate attempt to stop the bleeding, but by then the damage was irreversible. The aftermath was brutal. What began as a technical failure quickly became a crisis of trust. Do Kwon, the public face of Terra, found himself at the center of one of the largest collapses in modern financial history. As losses mounted, regulators stepped in. Investigations were launched, promises were scrutinized, and narratives began to unravel. In the aftermath, questions turned into accusations. Had investors been misled? Were the risks fully understood? The idea that code alone could replace responsibility was no longer convincing. Because when systems fail at scale, accountability follows. And this collapse would leave consequences far beyond Terra itself. The collapse of Terra Luna changed the crypto industry forever. What was once dismissed as impossible had happened in plain sight. Governments accelerated regulation. Stablecoins came under intense scrutiny. Developers were forced to confront a hard truth. Algorithmic stability without real reserves is a fragile promise. High yield always carries hidden risk, and systems built on confidence alone cannot survive a crisis of trust. The lesson was simple. In finance, as in life, incentives matter. And when those incentives break, so does everything built on top of them. This is Rise and Reason Studios. We explore the stories behind power, capital, and collapse.